Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello, my name is Vinay Joseph and I'm the Chief Investment Strategist at Standard Chartered Bank India. We have just released our Outlook 2022 titled Transition to Mid-Cycle, and today's podcast we summarize our key views. In our assessment, 2022 is likely to see markets transitioning from early cycle to mid-cycle. We see a withdrawal of monetary policy stimulus defining the transition to mid-cycle, similar to 2003 and 2009 market cycles. Volatility rises during the period of transition, with equity returns being more modest during this phase, mirroring earnings growth. India's macro environment remains strong as growth and inflation are expected to stay above trend amid a still supportive policy environment as fiscal policy takes over the mantle from monetary policy. Given this macro backdrop, our key investment takeaways are as follows. First, we expect equities to outperform bonds and cash in 2022, but at a more modest pace than 2020 and 2021 and with higher volatility. This is not unusual, but a characteristic of mid-cycle environment for equities after a recessionary bounce. Equity earnings is likely to be the main driver of returns in mid-cycle environment. We expect the current earnings cycle to be better than the last one with many positive drivers. Consensus expects a Nifty index EPS CAGR of 16% over FY19 to FY23 estimates compared to a near decade-long earnings lull of FY12 to FY19 when Nifty index EPS CAGR grew only 4%. Second, strategies within equities are expected to be increasingly important for equity allocation performance. We have a preference for large cap equities over mid and small cap equities going into 2022. Driven by three basic factors. First, large cap equities provide a greater margin of safety during periods of high volatility, a characteristic of mid-cycle transition. Second, large cap equities earnings growth and more importantly, EPS revisions continue to outpace those of mid-cap and small cap equities. And finally, 2021's strong outperformance of mid and small cap equities has taken relative valuations to large cap equities close to historic highs. We also believe conditions remain conducive for a deepening of rotation to value. IT and materials were the major drivers of 2021's value outperformance. A reflationary macro environment, favorable valuations, and better earnings is likely to broaden the value rally. This is reflected in our preferences for sectors like financials, consumer discretionary, and industrials. The third key takeaway is diversified bond allocation is key to manage interest rate risk. We view bonds as a core holding. A reflationary macro environment, higher fiscal spending, tighter liquidity, and quicker withdrawal of monetary stimulus by the RBI and the US Fed are likely to drive bond yields higher over the next 12 months. We expect the benchmark 10-year IGB bond yield to trade around 6.5 to 6.75% over the next year. In our view, a diversified bond allocation can help investors tide through an environment of rising interest rates. Our first preference is for corporate bonds over government bonds, given better corporate fundamentals compared to weak fiscal dynamics. We prefer high-yield corporate bonds on a likely reduction in credit default risk amid improving corporate profitability and inexpensive valuations of AA single-A corporate bonds relative to AAA corporate bonds. Our second preference is for short maturity bonds, given lower price sensitivity to rising yields compared to medium and long maturity bonds. Further, the rise in short-term yields over 2021 reflects RBI's normalization of excess liquidity and expectations of a rising interest rate trajectory. Our fourth and final key takeaway is we continue to believe that gold plays a very important role in diversified investment allocations driven by a variety of factors. First, history suggests gold does well in periods of high inflation. If inflation proves to be higher or longer lasting than our expectations, gold can act as a portfolio hedge. Second, we expect higher bouts of equity market volatility in 2022 given the transition to mid-cycle. This can be partially offset by gold. Lastly, our view of modest USD weakness should eventually offer a pillar of long-term support for gold. Though our baseline scenario remains positive for growth and risk assets, we would also watch for the following risks and how they will evolve over 2022. Inflation is the biggest risk to our positive outlook. While we expect inflation to moderate over the course of 2022, a persistent rise in inflation could turn macro conditions unfavorable for risk assets. We expect bond yields to rise on normalization of monetary policy, but an over-tightening policy error by central banks could drive volatility significantly higher for risk assets. COVID evolution could also pose some hiccups, as seen with the emergence of the new variant lately, a possible third wave, or a vaccine evading COVID-19 variant remains risk for a sustainable economic growth recovery. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.